For the second week in a row, we have the S&P 500 down, and when we look more closely, one of the affected industries has been the semiconductors, which are red right across the board. We'll also talk about one of the big reasons why this industry has been affected. And when we look at the fear and greed index, just 2 weeks ago when we were talking about this, we were sitting in extreme fear. Last week we were in greed, and now we are sitting in the middle of neutral, and we do expect this to continue to be very volatile with a few catalysts that we're going to discuss. Now, we also have earnings continue. Whilst we had a lot of the Mag 7 report last week, we still have some very large names, and we do believe some exciting companies to report. We have Palantir on Monday after the market close. We'll have SMCI reporting after the close on Tuesday, which lots of investors are going to be taking a look at given the massive drop it's had, which we will just briefly run through. And there are also some other interesting ones. We have our eyes on NVO. We have Mercado Libre, a very strong growth company that we will take a closer look at next week. And we have the famous REIT MPW, lots of volatility over the last few years. Now, today's episode, we are going to run through 8 high-quality dividend stocks that have massive future growth. We're going to look at each one in detail. We're going to run through their earnings, how have they done historically, how are they looking to do over the future. We're also going to cover their dividend safety, but not only that, we want to look at a lot of very important metrics that you need to know for each company. This will include looking at both dividend yield theory as well as the forward P in relation to the last 5 years. We're going to cover a wide range of metrics for each company, their free cash flows, their ROICs, their total debt, and as always for each one of these, we are going to run them through the valuation model. We're going to get to our own intrinsic value. We're going to discuss the margin of safety that we see on each one of these stocks, and we'll also talk about where Wall Street see these over the next year, the upside as well as their forecasted price. Now, before we do that, let's just talk about a few of the catalysts that we have for the upcoming week. And the biggest one you could argue is the US election that is taking place on the 5th of November. And we have UBS, who effectively believe that no matter who wins, we are going to see a lot of volatility in the market. So something just to consider, and right now it doesn't seem to be any clear winner, and that is why the market does seem to be a little bit on tenterhooks. So just bear that in mind as the election is upcoming, and the days after we do expect a lot of movements, which we will cover on this channel. We also have another eventful day next week where the Fed is going to speak. What interest rate are they going to cut by, or in fact are they going to hold? Now, Larry Fink, he is the CEO of BlackRock, and they hold a significant amount of assets under management. We're talking over 10 trillion. He believes we're only going to see one interest rate cut, whereas the market right now has priced in 2 trims. Remember, the last cut we saw was in November for 50 basis points. The overall market is thinking 25 to 50, but as we can see here, Larry Fink believes we'll only see one, whether that's just a 25 or a 50 basis point cut. Potentially the biggest news of last week was we saw the Supermicro Computers company down 50 billion, and that was a phenomenal crush to their overall market cap. In fact, the funny thing is it was just recently added into the S&P 500. So if you are a holder of an ETF that tracks the S&P, like VO, like SPY, you would have got all of the downside of SMCI and none of the upside that we would have seen. And the biggest catalyst for this drop, which has continued all of last week, was that their auditors, Ernst & Young, effectively said they are resigning, which is a big red flag. Remember, we have the Hindenburg report, we have the probe by the Department of Justice around issues of their accounting, their control procedures, which effectively means some of their numbers, maybe all of their numbers, could be fraudulent. Remember, they are meant to be recording after the market close on Tuesday. We had some fresh news just from yesterday, good news for Nvidia and probably the overall market. They are now joining the Dow Jones Industrial, taking place in effect of Intel, which is probably a good sign. Nvidia just over the last year is up 170%. For those of you that know Intel, they have had a very tough time. In fact, as we can see, during the same time period that Nvidia is up massively, Intel has lost more than half of its market cap. So great news. In fact, it wasn't too long ago that we did see Amazon added to this in February, so just something to point out. Now, also this week, we've had the Mag 7 report their earnings. Very, very strong. In fact, Alphabet was absolutely phenomenal. The market liked this very much, and their numbers were significantly better than expected. A very quick look for those that maybe missed that last week, we can see their earnings per share up significantly, 212 versus 185. Revenue up significantly as well, nearly 1 billion more than what the market was wanting. Their YouTube revenue was up, their cloud revenue was up, as well as their traffic acquisition costs. So all looking very, very strong. A company that has been growing around 15% year on year. And on top of that, their bottom line also looked very, very good. 26.3 billion, up in fact from the 19.7 billion that was reported in the same quarter last year. Now, a bit of a spoiler alert, that is one of the stocks we are going to be talking about today, and even with the market increase that we saw, we believe this is still one of the best potential undervalued companies in the overall market. We also had Amazon, another Mag 7 with phenomenal growth. Market also loved this a lot. The shares were climbing after hours, and we can see a massive beat to the EPS, 143 versus 115. Their revenue again up around 1 billion, although we do noted their AWS did come in very slightly under by around 100 million. Their advertising pretty much in line. So looking very good for this company, although the only issues that we are seeing at the moment is that AWS is growing at a slower rate than effectively others, when we can see Microsoft is up around 33% and Google Cloud around 35%. Then finally that we want to discuss Microsoft. Now what happened with this company was that there was weaker guidance than what the overall market wanted, but purely from their top line, their bottom line, their EPS, we can see a very nice beat, 330 over 310, and their top line revenue 65.59, better than the overall 64.51 expected. So revenue was up 16% year on year, bottom line also up around 11%, but the main killer here for the market, their range, and you can see it is very, very minimal. We're talking they're expecting 68.1 to 69.1, but the market was hoping for around 69.83. Now, very important to understand, not only do companies in this essential market need to be beating on EPS and revenue like we see Microsoft have done, but if they're not also increasing their guidance or at a bare minimum hitting what the market want to see, then they will be punished. Microsoft, while we're not covering that today, did get punished and is down. We had a separate video if you do want to check our thoughts in detail. Finally, before we look at the stocks, Estee Lauder, whilst we were looking at companies that performed very, very well, unfortunately withdrew their forecast. They're blaming a lot of their issues on the China recovery, which is seeing double-digit decrease to what they wanted to see, and therefore the shares of this company got absolutely hammered. Again, another one that we have covered not too long ago on the channel. Now let's jump into our first stock. It is ASML. Now this is a semiconductor giant, and this is up around 11% over the last 12 months. Over the last 10 years, significantly outperformed the S&P, up 574%. Right now, pretty much trading towards its 52-week lows. We have a double buy rating from Seeking Alpha and Wall Street, a hold from Quant. Now the yield pretty much sits at the 1 percentage point, and the forward P around 32.7, but we will compare that to their 5-year average. Now we like this company a lot, and we can also see over the next 4 quarters, ASML management are targeting double-digit increases to the EPS year on year. Just look at the last 4 quarters, 100% track record of outperforming what the market wanted, very sizable beats as well. And for the next full year, EPS 26.1, that will lower the forward P to 25.85, so definitely one to consider. And then when we look at their metrics, or underlining in fact, 82 dividend safety score, very safe, nice to report. We'll cover these 2 models which show undervaluation. One thing we would say though, disappointing growth to their dividend in July this year at 4.8%. As we will show you, typically it has been higher. Now, dividend safety score was just reaffirmed days ago, effectively meaning that a dividend cut for ASML is highly unlikely. Now, for each one of 8 of these companies, we will look at key metrics from the last recession, 07-09, and in fact, they cut the dividend, so just bear that in mind. Didn't maintain it, didn't increase it. They had below average growth, negative 56%, when the S&P was negative 12, and their return pretty much bang on the S&P, negative 55. As we mentioned, pretty much keeping up in line with inflation this year at 4.8%, and this is the disappointment we have. Last 5 and last 10 years, they've been increasing that dividend at a strong double-digit rate, but bear in mind they have only been increasing those dividends for the last 14 years. Then when we take a look at this model, essentially comparing the company against the 5-year average of the forward PE, when we zoom in over the last year, we are noticing now, remember the blue tunnel is the expected fair price. This company is well below even the lower end, giving us severe undervaluation. So we will discuss that shortly as well when we run each one through our valuation model. In terms of dividend yield theory, each one of these companies, we're going to compare their yield against the 5-year average. When it's above, like we see for ASML, that is an undervaluation signal. We also note another undervaluation signal as the forward PE 27.1 is below the 5-year of 34.1. Just remember, we don't look at any of these models in isolation, and we can see right now the sector of information technology at 26.5 isn't far off ASML's 27.1. Now let's take a look at their free cash flow payout. As we go along today, we are focusing on free cash flow as earnings is susceptible to manipulation by management through accounting. Below 50% is what we want to see for semiconductors, below 60% as a typical blanket rule. 2023 at 74%, so no surprises why in fact we did see the mediocre increase this year. Nice to see over the next 12 months expected to come down to 15%, hence why in fact for this company we are anticipating next year to be strong double-digit dividend growth. Free cash flow, what we want to see consistent increases over the longer term. Bear in mind, ASML is in the semiconductor space, very cyclical, but it has increased 153 to 825, although we do want to point out it has been decreasing over the last few years. Nice to report though, over the next 12 months, expected to jump to around 2080 per share. Then we get to free cash flow. Now we did say it's cyclical, but more often than not, they have produced some stellar reports. In fact, double digit nearly every single year, 30% in 2023. And when we do zoom out, what in fact we do notice, 6 billion in 2014, 27.6 in 2023. So that is a nice growth of 4 times over the last 10 years. Now we want to see companies that do share buybacks, returning excess cash to shareholder pockets. We do notice they've bought back around 10% from 2014. So this is nice to report, but do bear in mind it is a little bit inconsistent year on year. Then we get to ROIC, our favorite metric, 10% or more, 12 for semiconductors. Give us faith, management are able to effectively allocate their capital, and we can see it's been increasing over the last 10 years, in the high 40s over the last few years, so very strong. Investors and potential investors will love to see that. And then we get to operating margin. Now remember, for this, we want to see operating efficiency increases over the longer term, in line with the revenue, and we get that not only above the minimum 16%, but it's gone from 26 in 2014 to 33 in 2023. We then also note free cash flow margin above the minimum every single year. Yes, inconsistent, nonetheless though looking very, very good. Then we get to the final metric for each of these companies, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. We want to see below 1.5. The numbers below, or for ASML, we should say the lack of numbers, indicate the number of years it would take the company to pay off all of their debt net of cash on hand. For ASML, it won't even take them 1 day. And given this correlates to dividend safety and balance sheet strength, this shows us their balance sheet very, very strong, things that we do love to see. Now let's jump into the intrinsic value, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value, $1,129, we got it by running it through the DCF model. Now we have the free cash flow year on year, average growth around 35%. We've gone 20% moving forwards. As you can see, we have a low, medium and high. With the 20% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, indicating 67% upside. Now these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for ASML or any others. Full transparency, we will show you though at 15%, this would indicate $834, still giving 24% upside. And for those that believe it should be higher, at 25%, 1518, indicating more than a double from the current price, 125%. So what we always do is we take the 20% and the medium rate into the final slide. We always like to use a margin of safety, which we execute on at 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, a buy up to $1,016, then we keep going till it's near the current trading price. And what we can see in today's episode for ASML, you are getting a 40% margin of safety on what we deem to be a very, very high quality company. And we can see Wall Street very bullish, whilst they have lowered their forecast over the last month. $918, they see upside of 36%. As always, do give us your thoughts in the comments below for each one of these 8 stocks. 40% MOS, 36% upside. Is this one you are looking to buy, hold, or sell? We also want to let you know every Monday morning we send a free weekly article into your inbox where we cover undervalued companies that we believe deserve your attention, as well as what's gone in the market over the last few days. So click on the pinned comment, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information running through the upside that Wall Street see over the next year. And as well as that, you can grab 22 undervalued stocks that Wall Street themselves believe have the most upside right now out of the S&P 500. So click below, sign up, and you can read straight away. We then move on to S&P Global, a very, very high quality company. Now it is up 38% over the last 12 months. Over the last 10 years, again outperforming the S&P, up 434%. This one has pulled back from the 52-week high of $533. It has a forward yield of 0.75%, a forward P of 31.7, and we get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. Now when we take a look at this company, we can see growth expected over the next 4 quarters, and we also notice out of the last 4, they've beaten 3, so 75% track record. The one they missed was marginal by 1 cent, and nice to report the last 3 have all been beats. Now they expect growth to the EPS moving forwards, and we can see that will lower the forward P to 28.85. In terms of dividend safety, well, 99, very safe, highest score obtainable. Very poor to report though this year, their dividend increase was a bit of a joke at 1.1%. Then in terms of the last recession, well, they increased the dividend and they had below average growth at negative 38%. And whilst over the last year, the increase was only 1.1, over both the last 5 and the last 20 years, this company has been increasing those dividends at a double-digit rate. They're also a very new dividend king with 50 years of consecutively increasing that dividend. Then we move on to this valuation model based on the forward P, and right now we do see it pretty much around the midpoint of the fair value. But when we do take a look over the last year, this is a company that has typically traded towards the upper end of that expected price. Then we get to dividend yield theory, where we notice both the yield as well as the forward P aren't too far off the 5-year rolling, so you could argue reasonable valuation. And we do note it is significantly higher than the financials overall as a sector, but this is a very high quality company, and when we have done our deeper dives, we do believe this definitely deserves a premium to the overall sector. Then we get free cash flow payout. Over the last 10 years, it's been pretty consistently below 60%, 32 in 23, 22 over the next 12 months. So we really do hope this January, which seems to be approaching very quickly, they do offer a very nice increase to the overall dividend. Now, free cash flow has in fact tripled over the last 10 years, but very inconsistent on a year-on-year basis. We do notice though massive growth expected over the next 12 months. And when we look at their top line revenue, yes, 3 to 7% is what we want at the low end, but we notice double-digit revenue over the last 4 years and expected in 2024, trailing 12-month right now, showing us the 12 percentage point. And we can see more than doubled their top line over the last 10, 5 billion to 12.5 in 2023. Now, they were buying shares from 2014 to 2021, but they did have a recent acquisition over the last few years, which is why we do in fact see this number go up. But just over the more recent quarter, they have started to restart those share buyback programs, so we do anticipate this will start to come down in the future. ROIC as well, the numbers were very good just over the last few years, like we will see with the majority of metrics. They have come down lower due to the acquisition. Margins very, very strong, even though that has come down at 40%, which has been an increase over the last 2 years, looking very, very strong. We do expect this to go back up to the levels we saw in 2021. And free cash flow margin looking like a free cash flow machine. Very good numbers, 37% on a trailing 12 month. Then we get to the net debt to EBITDA, below 3 consistently, 1.81 in 2023, expected even lower over the next 12 months. Very low free cash flow payout as well, so the dividend is safe and the balance sheet for S&P Global does look very strong. Then we get to the intrinsic value, $530, As you can see, we have gone for a growth rate of 16% moving forwards. This is the medium rate. Now, we won't show every single valuation for all of these companies, but just so you know, if you want to see what the other values would be and why in fact we've gone for 16%, that is lower than the average and lower than the more recent year. So in terms of intrinsic value, we get 531, which is substantially lower than Wall Street at 585, where they see 21% upside. So if you want to argue our valuation is fairly conservative, at 10% is where the price is right now, not far off. So on a conservative estimate for a very high quality company, you're getting a 10% margin of safety, with Wall Street indicating 21% upside, and as we saw, they also gave it a buy rating. As always, do give us your thoughts as we go along today. We then move on to PepsiCo, which has come down quite some way from the 52-week high of $184. Right now, over the last year, pretty much flat. Over the last 10 years, up around 71%. We can see their all-time highs pretty much May of last year at just under $200. Now, we only get one buy rating from Quant and a hold from the other two, which is quite funny. Typically, it's either these two with the buy and Quant with the hold. Now we have the opposite effect. In terms of the forward yield, sitting at 3.3% and a forward P sitting around 20.3. Remember, the S&P right now sitting around 25. Now, in terms of their earnings, looking good, expecting growth over the next 4 quarters, and have beaten over the last 4, 100% track record. December 2025, next full year, also expecting growth to the EPS, bringing that forward P down to around 19.2. Now we get another very safe dividend score. We get massive double undervaluation on the yield and the PE valuation aspect, and we can see a fairly decent 7.1% increase in February this year. In terms of the last recession, well, they actually increased the dividend. They had above average growth, and they also outperformed the S&P negative 35%. And they are pretty consistent, aren't they? I mean, 7.1% increase in February this year, 7% on average over the last 5, and a nice double-digit increase over the last 20. And similar to S&P Global, they are also a dividend king, 51 years of consecutively increasing that dividend. Then we get to look at the forward P. Now, when we zoom in over the last year, pretty much telling us, in fact, over the last 12 months, this company has been severely undervalued, and something we will look at in our valuation. We also get that on both dividend yield theory and the forward P. This company has a yield that is much higher than the 5-year rolling, and a forward P that is much lower than the overall 5-year average. It is, however, marginally higher than consumer staples at 18.2. In terms of free cash flow payout, this is a little bit of a worry because we say maximum 70% for this industry. But on a trailing 12 month at 3 digits, this indicates to us management have paid out more in dividends than they've generated in free cash flow. Nice to see it lower over the next 12 months, but definitely something to consider with this company. Free cash flow per share as well hasn't been increasing over longer term, but also have realistic expectations. Don't expect the same that you see from tech companies or fast growing companies than you expect from a company like PepsiCo. Nice to report though, over the next 12 months, it is expected to increase to 776. Then we get the sales growth. Again, not that 3 to 7% on a very consistent basis, but the last few years have looked very strong, although decreasing, and 0% on a trailing 12 month is definitely something to take a further look at. Nonetheless, they have increased their top line by around 40% over the last 10 years, and with shares outstanding, yes, they have been buying back shares, but at a very slow and very inconsistent rate. ROIC, always love to see consistency, and that is what we get with PepsiCo, above the 12%, around the high teens year on year, and sometimes you do have to pay a little bit of a premium for those companies that show consistency. Again, we get that in the operating margin, no operating efficiency, but straddling pretty much around the 16% year on year. And whilst the free cash flow margin has been decreasing, still above the minimum 7%, we get 9 in 2023. Then we move on to the net debt to EBITDA, below 4, so we increase it for consumer staples, below that every year, in fact decreasing from the highs of 2020, 1.83 anticipated over the next 12 months, so it does look good. Then we get to the intrinsic value at $188, which is the average of these 3 models. Remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's PepsiCo or any others. Now with the current price at 165, MOS at 10%, pretty much a buy at 169, not at the 15% level yet. So for PepsiCo, we see between 10 to 15%, with Wall Street indicating upside of 12%, 185 price target. Remember, they did give this a hold rating. So 15% at 160 for those that want to see further on, 20% at 150, and 25 at 141. So 10 to 15% MOS, 12% upside. Is this a buy? Give us your thoughts below. We then move on to MSCI, a very high quality company. Another one that we have seen has pulled away from the 52-week high. A double buy rating with a hold from quant. Forward yield 1.1%. Forward P 38.5. And we can see over the last year up 22.5%. Over the last 10 years, massive outperformance of the S&P, up 1,118%. In terms of the earnings, looking very good. 3 of the next 4, they're expecting double-digit EPS growth, 100% track record historically over the last year, and with growth expected into 2025, forward P expected to come down to just below 34. Now, dividend safety, 61, does look to be safe. Another double undervaluation and a very attractive 16% increase to the dividend in January this year. In terms of the key metrics, well, we can see recession sales plus 1.5% when the S&P itself was negative. And over the last 5 years, massive growth to the dividend, 24% on average year on year, with 9 years of consecutively increasing the dividend. Then we get to that valuation based on the forward P. Over the last year, we do see it towards the lower end of the expected price, and right now we see it just outside, giving us that severe undervaluation signal. And we also notice the yield is above the 5-year, the forward P significantly lower than the 5-year average, another double undervaluation signal. Although, as we have said, it is above the financials, and when we have done our deeper dives, it definitely deserves a significant premium. Now, in terms of the free cash flow, it is below 60% consistently, 38 in 23, 36 over the next 12 months. Just goes to show you, if they want to increase it consistently at a rapid rate, for the time being, they definitely can. An absolutely gorgeous free cash flow to look at. The consistency, the increases, in fact, nearly 7 times over the last 10 years, and expected to increase again over the next 12 months. Then we get to sales growth, where we see nearly double digit every single year, looking very good, especially over the last 4 years. And when we do zoom out, this company has increased their top line 2.5 times over the last 10. We also like their shares outstanding. They have been decreasing at a very favorable rate. Some years buying back more shares than others, but overall it is very nice to see, especially when this company does give those very attractive dividend increases. And ROIC not only very strong, but increasing in the mid-30s over the last 2 years, 39% on a trailing 12-month basis. Lots that we do like to see. And their margins absolutely phenomenal. Yes, it trades at a high forward PE. Yes, valuation may be a little bit expensive, but you are buying sheer quality here. And we also note, in fact, operating efficiency over the last 10 years, and the free cash flow margin showing us a true free cash flow machine, 49% on a trailing 12-month basis. Now, we did get the dividend safety score at 61 safe, lower than those we have seen today. Their debt levels are a little bit high, 2.7, which is not too far off the 3, but nice to see that over the next 12 months, they are confident this can come down to around 2.2. In terms of our valuation, $664, not far off Wall Street 662. They see 15% upside over the next 12 months. And when we take a look at 10% MOS, a buy at 597, at 15%, not far off, leaning more towards 15% than the 10. And for those that want to see, at 20%, around 531, at 25, around $500. So today's episode, around 10 to 15%, with 15% upside expected from Wall Street, but a very high quality company nonetheless. We then move on to Alphabet. As we discussed at the beginning of the episode, very, very good earnings. Strong buy from Quantum, that's nearly a 5 out of 5 for them. A buy from Seeking Alpha, a buy from Wall Street, trading at the upper end of the 52-week range. A forward yield of 0.47%, forward P of 21.4, and over the last 12 months, up 35%. Over the last 10 years, up 521, massive outperformance of the S&P, and they still expect strong growth to the EPS year on year. Next quarter, in fact, 29%, and the previous 4, they've all been beats. Very large one that we just saw in the more recent quarter. With the next full year, 8.93, lowering that forward P to 19.2. It is right now the cheapest Mag 7 stock, and definitely the one that we do like the most in terms of valuation. Now, dividend safety score sits at 80, and we do have the undervaluation on the forward PE. When we take a look essentially at those key metrics, we can see plus 8% of sales during the last recession. No dividend was paid, so no comparative data. And when we do take a look, this company, especially over the more recent period, has been trading at a severe undervaluation, to the expected fair price. And we would typically look at dividend yield theory. They've only recently started to pay a dividend, so one we won't focus on too much. But the forward P sitting below 20 is lower than the 5-year rolling. Again, this does look to be incredibly undervalued. It is marginally higher though than the communications sector, but this definitely does deserve a very nice premium. In terms of free cash flow payout, well, over the next 12 months, 11%, very low, so we should see some nice growth from Alphabet moving forwards. Free cash flow been increasing more than 5-fold over the last 10 years, increase expected again over the next 12 months. And when we look at the sales growth, we can see nearly every year double-digit increases to their top line. Last 12 months, 14%. We do expect 2024 to be a very good year for Google. We then also can see the growth, in fact, more than 4 times over the last 10 years. And they've also been buying back shares, especially over the more recent period, something they are expected to continue at least for the time being. Then we look at the ROIC, very, very strong, especially the last 3 years. 32% on a trailing 12-month basis, also looking very, very good. And with the operating margin, we like to see that operating efficiency, margins around 32% on a trailing 12-month basis, with very good free cash flow margins, very consistently 17% on a trailing 12 month. Very similar to ASML, wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Absolutely phenomenal balance sheet. Now our intrinsic value, $215, we have updated this based on that latest quarterly report, so we will show you very quickly. We have the average growth rate around 12%. With that discount rate, we can in fact see our new intrinsic value of 215, giving this essentially 26% upside. But for those that want to see 10 and 14, we can see here 247 and 187 as well. So with the 215, pretty much bang on where Wall Street see this as well over the next year, 26% upside, and with the MOS at 10%, a buy at 194, at 15% 183, at 20%, pretty much where we see this company now. Mag 7, very, very good financial metrics, very good quarterly report, 20% MOS and 26% upside. We then move on to Nike, which is one that Bill Ackman bought in the latest quarter of his disclosure portfolio, so we will take a look when he releases the new one soon to see if he's added more. Over the last year, down 23%, over the last 10 years, up only 64%. We can see all-time highs sitting effectively around the $180 mark. Right now trading at it or toward, in fact, its 52-week low. A double buy rating with a hold from Quant. Forward yield 1.9% and a forward P sitting at just under 28. Now in terms of their earnings, out of the next 4 quarters, 3 of them, in fact the next 3, they're expecting massive double-digit decrease to the EPS. Nice to see though, over the previous 4, very good substantial beats, with an increase expected to the EPS May 2026, lowering the forward P to 23.72. Now we do get a very safe dividend score with a massive double undervaluation signal and a nice 8.8% increase last November, signaling to us we are expecting for this company an increase over the next few days. In terms of the key metrics, well, they increased the dividend during the last recession, negative 7% growth, a little bit better than average, and also outperforming the S&P, negative 36%. Over the last 5 and the last 20 years, they have increased that dividend at a double-digit rate, and we can see 22 years of consecutive increases, 3 years away from becoming a dividend aristocrat, with 40 years of paying a dividend without a reduction. Then when we look at the valuation on the forward P, over the last 12 months, nearly every single month, in fact, it has been trading much lower than the bottom end of the fair price, and we can also see massive undervaluation, the yield significantly higher than the 5-year, as well as the forward P below the 5-year rolling. We do, however, note it does sit much higher than consumer discretionary sector at 13.9. Free cash flow payout, 33% over the last full year. A little bit of a worry, it is expected to increase sharply to 86% over the next 12 months. And the free cash flow per share, whilst it has doubled over the last 10 years, very inconsistent on a year-on-year basis, and a large drop anticipated over the next 12 months. Now, sales growth has been pretty much around 3 to 7% year-on-year, although it was flat over the last full year, and we do expect, based on the trailing 12 month, that it will be a decrease into the next period. In terms of numericals though, it has increased their top line around 60 to 70% over the last 10, and they've also done some share buybacks, very inconsistent though, so I wouldn't count on that too much. Unlike the dividend, which we do expect, we will see a nice increase over the next few days. ROIC looking very consistently around the 20s year on year, 25 in 2024, 22 on a trailing 12 month. And when we get to the margins, pretty much consistently around the 12%, no operating efficiency noted. And when we look at the free cash flow, looking better than the minimum of 5% year on year. Net debt to EBITDA, very strong, not as good as Google and ASML, but still one of the best we are looking at today. 0.05 in 24, 0.27 over the next 12 months. No surprise then why we did see that very good dividend safety score. In terms of our intrinsic value, just over $98, not far off Wall Street where they see 96, upside of 23%. And with our MOS in today's episode, what we are seeing for this company is you're effectively getting a 20% margin of safety if you believe in the longevity of this brand, if you believe it can continue and keep up its market share with other competitors trying to steal it, you are getting 20% MOS with Wall Street, as we said, 23% upside. We then move on to one of our favorite REITs at this point in time, Rexford Industrial. It's down 3% over the last year. Over the last 10 years, though, it has outperformed the S&P, up 190%, trading at its 52-week low, a double buy rating with a hold from quant, forward yield just under 4%, P to FFO, funds from operation, sitting at 18. And when we look at the quarters, well, next 4 they are expecting growth, and at a minimum over the last 4 they have been at least in line. FFO expected to increase, which in turn lowers the forward P to FFO to 16.7 over the next full year. Also a very safe dividend score, severe undervaluation again on yield and the P to FFO, and a very nice increase, 9.9% to the dividend in February this year. In terms of that dividend growth, they have increased this at a double-digit rate over both the last 5 and 10 years, and we can see 10 years of consecutively increasing the dividend. Then when we get to this valuation, we do notice over the last year, it's been trading severely below, so this could be a great opportunity if you want to consider adding a REIT to the portfolio. And as we said, yield massively above the 5-year, forward P to FFO sitting massively below the 5-year average, but we do note it does sit higher than real estate overall of 16.3. Now with REITs, we tend to ignore the free cash flow, a lot more volatile, so we focus on the adjusted FFO payout ratio. Below 90% is what we want, that is what we get, expected to be around 82% over the next 12 months. And when we look at the AFFO per share, similar to free cash flow, we want consistent increases over the longer term. That is what we get and expected over the next 12 months. Then we move on to the sales growth, which even though it has been slowing, still above the 5 to 10% that we set the target as for real estate investment trusts, 26% in the full year. And then when we look at the AFFO share growth as well, looking very, very strong, probably the best that we've seen, significantly better than the likes of Realty Income, Stag Industrial, Vici Properties, and others. 7% in 23, 5% expected over the next 12 months. And then when we move on to looking at their total sales numerically, we can see this growth more than 10 times over the last 10 years. But we do have to point out, REITs will dilute your position over the longer term. They do retain little of that internally generated cash flow. Lots of it is paid out as dividends. But as we can see, this company does dilute your position at a fairly rapid rate, much higher than the majority of the sector, something to bear in mind. And for our IC, what we want to see for REITs, around 3 to 5%. So it has increased, but right now in 2023, it is pretty much sitting at the lower end of our target. Operating margin, very good operating efficiency over the period, so that is a great sign. We are getting those efficiencies that we always like to target. And the net debt to EBITDA below 5.5, 4.06 in 23, an increase expected over the next 12 months. Something to keep an eye on, but for now it does look to be good. Then when we get to our intrinsic value, $59, so that is a nice MOS today for REXR, 10% a buy at 53, at 20% a buy at 47, and what we can see in today's episode, not far off a 30% margin of safety, sitting somewhere between 25 to 30%, with Wall Street, as we can see, $56 price target, 32% over the next 12 months. Let us know if this is a REIT that does take some interest. We then move on to Keurig Dr Pepper, up 8% over the last 12 months. It is trading in the mid to lower end of the 52-week range, triple buy rating right across the board, a yield of 2.8% and a forward PE sitting just above 17. Now they are expecting growth over the next 4 quarters, and at a bare minimum over the last 4 they have been in line or beaten, and we can see with growth expected the forward PE is anticipated to come down to just above 16. Now we get a safe score of 70 with both another severe undervaluation signals, and they did increase the dividend just a few months ago at 7%. In terms of the last recession, well, they didn't pay a dividend, so no comparative data, but their sales were up 44%, and on average, over the last 5 years, they've been increasing those dividends by 23%, with consecutive increases coming to 3 years. Then when we take a look at that 5-year average P model, zooming in on over the last 12 months, pretty much the whole year they have been trading well below the lower end of the expected fair price. And when we get to dividend yield theory as well as the forward PE, a massive, severely undervaluation signal. We also notice it does trade lower than the overall sector at 18.2. Now their free cash flow payout below 70%, red flag indicator in 2023, but we do like to see over the next 12 months expected to come down to 54%. We also notice their free cash flow has been very, very inconsistent, 61 cents in 2023, but expected to triple over the next 12 months. Then we get to their sales growth, which has been very inconsistent, although we do notice over the more recent period, their top line has looked very strong, and we can in fact see it has more than tripled over the last 10 years. We do notice though they did have a merger, and that is why we see these shares outstanding like this. Although over the last few years we can in fact see it has had very minimal movement, so not something for the time being they may be focusing on. ROIC above 12%, we don't really get that. We want to see the minimum 10%. The last few years straddling around the 6 to 7%. And when we look at the operating margin, it is good to see efficiencies 17 to 23% and above those minimums. Free cash flow margin also looking good, but we do see a drop just over the last few years. Then we get to the net debt to EBITDA where we want to see below 4. That is what we get, 3.34, expected to come down to 3.28 over the next 12 months. And when we run it through the intrinsic value, $40 is what we get, pretty much the same as Wall Street, who see 21% upside over the next year. 10% MOS, a buy at $36, 20% around 32, not quite there yet, not too far off. So in today's episode, we see around a 15 to 20% MOS, with Wall Street indicating 21% upside over the next year. As always, if you do enjoy the content, value is provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping a copy Monday morning. You can also grab access for November's undervalued stocks and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.